First, everyone, thanks for joining me tonight at the WOLFPACK's Technical Analysis 101 lecture. All right, I know a lot of you guys have been anticipating this for quite some time, so let's get to it. First off, I'm going to cover the basics in all of this lecture, and the basics will include the basics of technical analysis. It'll include things like the trend lines, the very bare basics, how to draw the correct support, resistance, where to see ceilings, as well as it'll cover some of the time spans, the more important ones, such as, and by time spans I mean the candlesticks, like the whether it's like 1 day, 15 minute, 30 minute, 1 hour, etc., etc. I'll also leave a little note at the end. I think I'll just include that in the website itself as far as how to read the candles themselves. I'm not going to go over that during this training. I'll do it in another one. But you can actually read the candles themselves, and it's very important and a very good tool to help analyze the market. I'll also cover stop losses so you guys can trade proactively with the group. I already covered stop losses in the risk management portion, so I'd like to cover how to actually place them during this portion so a lot of you guys can avoid getting wrecked. And also alarms. Like I said, I prefer alarms more than the stop losses, but you guys can choose either or. I'll also include the patterns in technical analysis. Like I've said multiple times before, I am considered a pattern trader. I use patterns all the time. I think they're very important to use in TA, and they're probably one of the more widely used tools within the day traders spectrum of ammunition. The patterns that I'll cover is the reversal patterns, which include the rising wedge, falling wedge, double bottom top, triple bottom top, head and shoulders, and inverse head and shoulders, as well as the continuation patterns, the flags, whether they're bull or bear, pennants, whether they're bull or bear, the 3-point drive, and as well as the wedge when it's going in a certain way. I'll talk about that later when I give you guys a live example. And then as well the bilateral, which include the ascending triangle, descending triangle, and the symmetrical triangle. Ascending triangles are, for the most part, usually bullish. They shouldn't really be bullish all the time, but this is crypto, and we're in a bubble, and everything must go up. What goes up must go up. So usually they're bullish, but I'll still cover it as a bilateral pattern. And then also the symmetrical triangle. I know a lot of you guys have gotten confused about that before, so I'll go into that a little bit and use as an example the big symmetrical triangle that occurred, I think it was like a month ago, or maybe a month and a half ago, I'm not sure. Time kind of merges together when you trade, but I'll cover the one that happened on Bitcoin that I got so many followers from when I called it coming down. Anyways, this is an example of all the different patterns. I'm basically just following this sheet. There are more patterns, but since this is the basics, I'll just be covering this one. In the future, I will go over the more advanced patterns, such as, you know, the cup and handle and the diamond bottom and things like that. But as you can see, the reversal patterns at the top, the double top, the head and shoulders, the rising wedge, etc., all the way down. If you'd like to get this picture itself, I'll provide it inside of the Discord channel. And then also when we upload this video onto the website, I'll also make sure that I upload this picture on there as well. And then also for tonight's little lecture, I'll be covering the basic indicators that I use. Indicators are extremely important because they help give you a lot of alarms and a deeper insight into the way that a market is heading. For instance, I usually use stochastic RSI to see whenever something is overbought or oversold. That's basically what it means. RSI is a relative strength index. I'm not going to go into the very advanced stuff of all this stuff, like the math and all that and all of that. I'm just going to give you guys the bare basics that you need to understand to successfully trade within the markets. I'll also go over the Bollinger Bands, the Fibonacci levels, the Ichimoku Cloud a little bit because I don't use Ichimoku Cloud that much. How to read the volume and why it's important to read the volume, and then as well the order book, which includes spoofing, like real walls, and then how to tell the difference between real walls, fake walls, whale manipulation. And also I'll cover the depth charts a little bit, but I'll mostly just say don't fucking use them. Anyways, let's continue. So we go over here to my little chart. And first we're going to be talking about the trend lines, right? So as you can see right here. Let's delete that just to make it look clean. So a trend line is basically you want to make sure that the line touches multiple points. Usually it should be like 3 points. Like right here, it's not touching that, but you can drag it out to here, and it's basically touching 3. Usually you want it to touch at least 3 points. If not, you can make a 2-point connect, and then try to see if it'll make the third point where it's at or where it's coming down. Like right now, I believe that game is going to create a third point right here, because it's having this nice little retrace down, and the 1 hour RSI is completely floored at the bottom. So around here it should start to like hit some buy volume and then kind of go up a little bit. So the supports are obviously the bottom of the price. Resistance is whenever the price is under it. So it's basically that simple. If the price is under a line, the line above it is considered a resistance. If the price is above a line, the line under it is considered, the line under the price is considered a support. And you can stretch this out as far as you want. It's usually very important to go as far as you can actually and get like the very bottom of these supports. Like this would be considered a support right here. It can touch right there, and at some point it may come back down, retrace down, and touch that. This would be considered a support right there. You can see 1, 2. I can zoom in on that for you. Just very basic stuff, guys. Thanks, Google. Alrighty. Clean this up a little bit. So there was the one support. Here's another one. Even though this very bottom, I don't know about using. We'll just use it anyways. I'll delete it, redraw it. Draw it from right there. Over here, you can see there's a 3-point touch support. 1, 2, 3. So you see, as soon as, even from here, as it went up and it dropped right here, as soon as these 2 points touched and it went back up, someone, or algorithmic trading bots or the market, whatever, drew these lines, and when these 2 points touched right here and it came back up, it already created support for the third point right here. So it touched, came back down, touched again, and it shot up. And you always want to try to buy at the supports, because that's basically buying at the lowest possible price. So if I was actually thinking about buying game down here, and I kind of kicked myself for not listening to my instincts, because as you can see, it just shot up. I was hoping that it would break the support and it would drop further, because it was just a 2-point support, which isn't a very strong support. I do believe that the more points that a support touches, the stronger it is. For example, let's go to token, one of my new little favorites. So for token, we can go to the 1 day, draw it out pretty far. And you can see right here that this is a clear pretty strong uptrend right here. That's a pretty, I mean, remember, this is the 1 day. So this is a pretty strong uptrend right here. It touches one, I mean, like multiple times here, but we'll just call that 2, 3 right here, 4, 5, 6. Like it just keeps, it does not want to break this uptrend line. So if you see something strong like this, like right here, it's kind of gone up, I think because people have sort of begun to notice this. But once it does trace down, you see that the one day RSI is coming up. Once it does trace down, you're going to want to set buy levels or buy orders down here at the support line. And there's algorithmic trading bots, which I think I'll go over tomorrow and in the next session of this, that they draw out these supports. They draw out these trend lines. So, and they usually have a lot of money with them or a lot of money backing them. So you kind of want to trade with the bots because they'll always be there backing you and buying low and selling high. So anyways, that's the support. For as far as the resistance, let's go to Bitcoin. Bitcoin's challenging a pretty strong resistance. Big Finax. Sorry, I don't have my mouse with me right now. Alright, so for this, let's just clear this. We're just going to draw trend. It's not there, it's right here. Right? No, I guess it broke it. Could have sworn it didn't break it yet. There we go. Should look clear. There we go. So as you can see, there's this resistance right here that it's been challenging for quite some time. And you can even put it up because if you look at this point right here, if you draw from the hard candle to the wick, there's still some resistance that it hasn't touched. Great. This thing there you go. There's still some air right there for it to touch another resistance. So it could have like a little short squeeze up and then like just be like a fake out and come down there and then hit the support again before an actual breakout occurs. But for right now, it's somewhere around here that it just can't break through. There you go. Perfect. So the way that you draw the resistance is basically the exact same way you draw the support. And there's multiple different ways. Some people draw it from the candles, some people draw it from the wicks. I draw them in whatever way fits. And in every way possible. Like if those a big distance from the candle, or if those a long wick, then I would draw from the wick to the wicks, and as well from the hard candles to the hard candles. But as you can see right here, it already broke through the hard candles, and it's like in this little channel. You can actually see that it's chilling in the little channel right there. So since it broke that first resistance, it's actually bouncing up and down on it as if it was support, because the price is over it. Like I said, if the price goes over a trend line, it becomes support. If it goes under, it's the resistance. So right now what we're trying to do with Bitcoin is we're trying to break that top resistance line. You can see where it popped right here, and that becomes a stronger resistance. 1, 2, 3 point trend. However, we are fairly bullish, so I think that once it hits this little support, it's going to break out. That's just my opinion. The market's just seem pretty bullish right now, but we'll see where it goes. So that's basically the basics of the support and the resistance. As far as the ceilings, let me see a good example of a ceiling. The ceiling is basically something like this, but this was for before. We can actually push this right here, and a ceiling is basically like the previous high of a certain point. So like right here, you can see that there was this little tweezer reversal candlestick pattern where it just came up, came back down. So that makes it a ceiling. So it's going to come right straight across, parallel, and then as the price comes up, like say it touches the support right here, breaks the resistance, it's going to meet challenge that ceiling because there's no other resistance coming at it basically. But the resistance that it has is usually these ceilings. That's why I always say that we're never a confirmed bull until we break the downtrend, the overall downtrend. Because once we break the overall downtrend, then most of the resistance that Bitcoin meets and the market as a whole, because the market follows Bitcoin, most of the resistance that Bitcoin meets are just these ceilings. So there'll be like a ceiling right there, right? There'll be another one like right here. As you can see, there's like the moving average of this little section right here. Here, let me just extend it so that it catches it all. So a little moving average right there. There'll be another ceiling right there. The moving average of this little top right here, this little section right here. There'll be another one right here. And then of course, probably one of the most important or biggest ones, you can get either the wick or the candle, is the double top ceiling. And there's a bunch of different smaller ones if you zoom in and everything, but these are probably the three biggest ceilings that we're going to be facing. There you go. So then once it breaks the overall downtrend, we go into what I consider, we're basically done with what I call the correction phase. This is all the correction phase. And then once it breaks up, it just goes and challenges all these ceilings and is stuck in this ascending triangle like over and over and over, which, as I said before, it's a bilateral, meaning it can go up or down, but this is crypto, and an ascending triangle is basically a bullish pattern. I mean, I rarely ever see ascending triangles break downward. So it'll, break the downtrend, come up here, the first ceiling is met. It'll most likely break that and then come up here, like do like a short squeeze or something, and have a little breakout. That'll come up, and then it'll like make this angle right here. It'll make more and more points. Like, say it makes a point right here, right? It just decides to do a short squeeze and it goes up. Then from here, it'll make this angle, right? And then as it comes up here or whatever, and it breaks up, it does this little breakout and it comes up here, and then it comes down, and it makes from right there to like right there, because it'll bounce right here and it'll continue going up, and then it'll just do that over and over again until we go parabolic. And parabolic's not really good, because once you go parabolic, once you start getting way too high, like let me show you the perfect parabolic example. I mean, this is parabolic. Look. And once you start going way too high, way too fast, it just crashes, and then it crashes, and then it starts, correcting, and then it goes up, and then way too high, way too fast, and just crash. So then, I mean, once you see that it starts going parabolic, you kind of know that you need to sell out. Like right here's a perfect example. This is like a clean parabolic curve. Like it's just going moon. It's perfect launch pad to go to the moon. As soon as it goes parabolic and just starts going straight up, that huge crash happens, huge crash, and then it starts doing it again, and then it just keeps on crashing as people take profits and crash the market. So, and this is another, this is an example of a ceiling that's used as a support. This is the 3K bounce that occurred recently. It was the previous all-time high, and before it was a ceiling. If you're under the price, but it broke out of it, goes up parabolic. But once it crashes, since you're above the price, that ceiling then becomes a support. So then everyone buys in right there, and that was a perfect buy for this bounce. As you can see right there, complete parabolic drop, perfect buy, and just like a huge spike up, which was awesome. And now we're where we're at. Alrighty. So that's the basics of the trend lines. As far as time spans and candlesticks, a lot of people, especially when you first start off, I mean, I know I was doing it when I first started off. I was looking really, really, really at like close at the like 15-minute, 5-minute candles, but I was also a very aggressive, what's called a I forgot. It's called like a high, not high frequency. I forgot, but basically it's just a day trader that trades on the very small volume or the very small candlesticks, and they trade a lot. High intensity. There you go. High intensity day trader. I learned about it from YouTube's when I saw YouTube videos of big players in Wall Street being high intensity traders, but I never put into account the fact that crypto moves like 100 times faster than the regular markets. So when I was doing it, I was trading like 8 different coins at once. Like think about like this, even more than this. I had eight coins I was tracking, but and they were all in different tabs, and I was literally going through on the 15 minute of each one for like 8 different coins, 8 different rallies that I was playing, and I was just riding the waves, buying low, selling high, buying low, selling high, this that, like over and over and over, and if I miss the entry on one of them, then I just forgot about it and like looked for another target for that, or et cetera, et cetera. But I had 8 different coins that I was tracking the entire time. Is it profitable? Yes, if you do it correctly, it can be very profitable. I was fairly well at doing it, I would say, and so that's what kind of skyrocketed me up, not just in terms of my funds or my capital, but also in terms of experience. I was able to make a lot of mistakes extremely fast, and I was able to do it multiple times, like many times, and sort of just see how the market moves, because you can look at the 1 minute and the market still moves for the most part the same as it would in the 1 hour. But the difference with the 1 minute, the 5 minute, and I would even say the 15 minute is that the closer you zoom in, the more unknown variables, the more craziness can happen in terms of volatility, because not that many people look at the 1 minute charts. All right, right now I can't find any patterns right here because Bitcoin's just been nasty lately. Let me see. Yeah, so look, this is a perfect example of the volatility. So like right here we have basically a rising wedge, right? Rising wedge, as I'll teach you in a little bit, is that's a reversal pattern, meaning a reversal going down. So if it's a rising wedge, the price should drop, but it didn't. It was a rising wedge, and the price went up. And I consider this a rising wedge in the 1 minute, just because it's not going to be perfect in the 1 minute. There's a lot of these like random spurts everywhere. So this is a rising wedge. It should have dropped, but it didn't. It spiked up. As you can see, there's a large buy volume right here. Even for the 1 minute, this is considered a fairly large buy volume. And then it continued the ride upward. Let's see where else. So that's an example of volatility. And the reason why it's volatile, like I said before, is because most people watch I think the number one viewed candlestick time span is the 1 hour. I believe it was Elliot who said that the 1 hour is the best to kind of clean up, to get rid of all the noise from trading, because if you look at the 15 minutes, if you look at all the other different ones, it can clog your vision. It can give you like a bunch of mixed indicators, and the volatility just goes everywhere, and it's just not pretty to look at. So the 1 hour is definitely, I would say, the most correct and the most common one, and it's usually the most correct because it is the most common one. You know, if you're thinking the same way that every other trader is thinking, or the way that algorithmic bots are thinking, then that gives you an edge in the market because you're moving with the crowd. You always want to be moving with the crowd, never against. The people that are moving against the crowd are the ones that get wrecked during trading, and that's you want to move with the crowd to profit from the people that move against the crowd. So the 1 hour is what I usually stick to. It's what I recommend everybody sticks to. But you can still zoom into to the other things like the 15-minute to get a grasp of what the 1 hour is doing. So say the market right here, you go to the 1 hour chart and you see the RSI is curving upwards, right? So it looks like it's going up, but you don't really know for sure if it's going to go up. So then that's why you zoom in a little bit and look at the RSI, like the RSI on the 30 minutes curving down. And then the RSI on the 15-minute is curving down, and it's about to start going up. But for right now, I'm going to say that it's going to go down because it has a lot of air between the bottom and the top. It's probably going to curve up a little bit just because the 5-minute is curving up. Yeah, it was a little bit, and then I think it's going to curve down right here. But you zoom in to see the RSI to see where the 1 hour is headed. So right here, since everything is curving down, it's probably going to go up a little bit right here, and then it's just going to start curving down. And this price range right here is going to come down and hit this little floor resistance support line right here. It'll probably break it. I think it needs to break it. And then it's going to come down and hit the support, and then from the support it should bounce up. That's what we're hoping on. That's what we're betting on. If not, I still think it's fairly bullish. It'll most likely just hit something else along the way or make another support down here somehow. I'm not gonna chart that right now because we don't have the time. But that's how you want to use the different candlesticks in order to or the time spans in order to get a grasp, a cleaner grasp of what's going on in the markets. I'll teach you how to. I'll talk maybe tomorrow or maybe in a more advanced session because I don't want you guys popping bubbles or trying to catch bottoms. But usually, like down here, the way that you can catch, use the 1 minute for. You should never be in the 1 minute first off, unless you're doing something like popping bubbles or trying to catch the bottom of a crash, and this is not cooperating with me at all. All right, well, if you look at the 1 minute over here, you'll see like a falling wedge right here, or something of that nature over here that was like an inverse head and shoulders. Like you zoom in really, you can't see that right here at all. You just see candles. But if you zoom in on the 1 minute, that's where you can see the reversal patterns really close, and they are there in the 1 minute, and that's the only time you should ever be in the 1 minute. I recommend to be in the 15-minute and the 30-minute just to see where the 1 hour is going. I recommend trading in the 1 hour. You know, you can look at the 4 hour to see the overall market where it needs to go. Like Bitcoin can cool down a little bit before the next pump up. And then of course, the daily is also another widely used time span. Like right here, Bitcoin could probably come down, but will it before a nice little breakout? That is to be determined. So we'll see what happens. But that's basically the candlestick time span breakdown. Another thing that I want to talk to you about was the stop losses. So we'll go into, perfect example is Bitcoin right now. So you're in Bitcoin and you don't know what to do. You know, the market's volatile as hell right now. It's a little split between the bulls and the bears, and you're not entirely too sure on whether you want to, you know, stay perma bull and just stay in without anything, or if you want to risk holding bags. So what you usually do is you draw out your support, right? Your little trend line support. And then you kind of create what you're comfortable with as in terms of in terms of a loss, you know, I'm usually comfortable with like a 5% loss. But if you want to be pretty bullish, like really bullish, and you can like bring it down to like 10%, something like that. Remember, I don't margin trade at all either. So when I pick out my stop losses is not with is not in mind of margin. I never margin trade, and the reason for that is because if you margin trade and there's a liquidation on your call, you lose all of those funds. And they will liquidate your funds. If I go to sleep or my stop doesn't trigger for some reason, or I forgot to set a stop or whatever, and the market moves against me, we're in a bubble. So more than likely, the price is going to go back up. So I forget to set a stop loss, and it crashes down for whatever reason because it's crypto and there's black swans everywhere. And the price crashes down and you lose your bet. You lose all of the funds that you placed down. If you didn't margin, worst case scenario, you just hold those bags and you never, and you just can't play with it, or you that's basically it. You just hold bags. To me, I don't really find that bad. I've held bags before for a very long time, and a very long time in crypto is like a month or 2 months. People just are not patient in this game. You need to have patience because if you went into the regular stock markets or Forex or whatever, trust me, you'd be waiting 1-2 months just to even. I mean, that a bit of an exaggeration, but just to get like a little bit of movement, you got to wait quite some time. It's not as crazy fast and volatile like crypto is. Crypto is kind of like penny stocks almost in terms of its speed. And Bitcoin's slow for crypto. If you look at, game right now, it moves up and down 20% in like a few hours. That's pretty crazy. Or earlier today, it moved up like 20% in just like 10 minutes. Anyways, for stop loss, you want to put whatever you're comfortable with. So if you see this right here, it's coming down, you're looking at the RSI, you track the RSI, you think that it's going to hit in this little area right here, right? Then you kind of put this little little tool to see where you would be comfortable with in terms of losses. Say you're only comfortable with like a 4% loss, right? Then you find out what price it is, you put 4% under the support, and then 4%, and you see the price over here. If you look at the right, it says 36.50. So then you can go into your, I'm not going to show you my GDAX, but you can go into like your GDAX or whatever the case is, and then put the stop loss in for 36.50. Personally, I am more interested in alarms than stop losses. So if Bitcoin were to break, let's say at the current price right now, if it just had a crazy crash, like a crazy whale crash, it'd just be 36.83. I use TradingView.com, which I love. Again, I'll say it every time I do one of these lectures. TradingView.com, definitely highly recommend it. So on the trend line, like add alert on trend line. Look at that. You don't even have to put an actual price. Add alert on trend line. Awesome. When it's crossing, does a loud sound for a minute, wakes me up, ruins my sleep. I love it. Boom. Alert added. And where's it at? I think this is it right here. There you go, crossing trend line. See, so if Bitcoin, I don't even have to add wherever. If Bitcoin breaks this line, this trend line, I'm gonna know about it immediately. My laptop's gonna go crazy, burr, 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 all night. I'm gonna wake up, girlfriend's gonna be mad at me, but whatever. And then I can analyze the market myself and figure out if it's something that I want to act on, or if it's just like a false alarm and just go back to sleep. Because if it comes down and it's just like a small little break of the line, right? It could be that you just didn't draw your line correctly, or it's like a stop hunt where it just kind of breaks it down a little bit, like a fake out, breaks down a little bit, and then it just spikes back up. So that's the bad thing about setting stop losses, is that sometimes people will set stop losses like right at the trend, and then it'll come down, dip, trigger your stop loss, and then not really be a full break. It'll just trigger it a little bit and spike back up, and that happens very often. So alerts way more important than, or way better in my opinion, than stop losses. And I think that is all I have for the stop losses. Very, very simple stuff, extremely effective, highly recommended. It's almost necessary for 100% necessary for risk management. If you're not using stop losses or alarms, then you definitely need to learn, because it will save you a lot of money and heartache. And the next things I want to talk to you about then was the patterns. The first thing, excuse me, first thing is the reversal pattern. We're gonna look at, where's a nice little head and shoulders somewhere. Inverse head and shoulder. Oh look, here's a nice little double bottom. Look at that, perfect. So the for the reversal patterns, I was gonna talk about rising wedge, falling wedge first, but here we caught a double bottom, nice in the wild. So a double bottom is basically just, you know, it goes down, hits a point, spikes back up, hits another point, comes down, hits that same point. Basically, it doesn't have to be like directly across. It can just be very similar. Usually, if the market is still fairly bullish, the first point will be lower than the second point by a little bit, and then it spikes up. So the way that you can confirm if this is a double bottom reversal is that on the second dip and then up, it needs to break that neckline right there. See, so once it drops down, a lot of people are always trying to like, oh, I'm trying to buy the bottom. I'm trying to buy the bottom, and they're so eager to put orders like randomly wherever they think it's gonna drop. Don't do that. Don't ever do that. You do not want to be in the vanguard of a war, of a battle. You want to be chilling in the back with Julius Caesar, sipping martinis. So when it comes down and does the double bottom, you want to wait before you bet your money in. You want to wait until there's a clear reversal pattern or some sort of indicator that it's safe to get back into the market. As you can see, a lot of people, these were brave soldiers right here. The market came down, these people bought in, and then they most likely sold out right here too. Smart people would sell out right here. And then it came down, and then other people bought in, maybe even these people. I've done that before. I was a lot braver in the past, but I've bought in at the bottom before, sold at this little bounce, and then bought in at the bottom again. Usually if it continues breaking down, like it's a dead cat bounce, then the people that bought here, sold here, and bought here, they'll just sell out again and try to do it at the bottom, or try to do it at the next bounce. But you don't want to be the one making this pattern. You want to wait until it forms the pattern, and as it comes right here, you can see that there's like these bears right here that sold right here, and then the bulls just overcame them, and as soon as it broke up, there's no more sells, or there's sells, but not as much as all of this. As soon as it breaks up, people get confirmed. Okay, we just hit a double bottom reversal, and you see all the buys coming in. Look at that, a bunch of green everywhere, because nobody wants to be the vanguard, the guy at the bottom. All right, so that's a double bottom reversal. It's the same thing for a double top reversal. If I can find one, I'll show you, though I don't think we've had a double top on Bitcoin in a while. Let me see. Maybe this can be considered a double top. I mean, I think that angle is a little bit too much of a strong angle for that. Any double tops? All right, so right here, I think this is considered a fairly safe double top right here. So it doesn't have to be completely straight, it just comes down a little bit. So the market came up, hit a ceiling, came down a little bit, came up again, hit that, around the same area that it dropped down before. It couldn't break it, and then people start to sell out because they see a double top reversal. So sells out. I don't know what happened here. This was some crazy whale, well, not whale, but some crazy volatility right here, and it came up again, and then you could even say that this right here is a triple top because it goes 1, 2, 3. So it came down, it came up, triple top, and then it just crashed because you could see that this was happening right here. This little pattern was formed. So then it crashed down, dead cat bounce, crash down, recovery. Let's see for the next one. I wanted to do a head and shoulders. I can't find it. Wait, is that it? No, it's the double one. And here's a regular head and shoulders, the big one that everybody was saying that we're gonna see 2,500 again. Where's this at? So head and shoulders, basically left shoulder down. This is the neckline. Creates the head. The head's always bigger than the shoulders, obviously. And then up, right shoulder, crash. I mean, it's a little ugly one, but there you go for the most part. I would consider this a head and shoulders just because it broke the neckline. As you can see, the entire pattern filled out with the triangles. So basically there's like the shoulder arm, which is usually, the crash is usually as big as the shoulder arm, from what I've gathered. I don't have anything backing that statement at all. This is just from what I've gathered. So usually this distance right here is like equivalent to like this distance right here. And as you can see, this is actually pretty long right here, and this goes all the way down to down here. So it's fairly equivalent. Anyways, so you have the arm, then the left shoulder, right? Left shoulder, once it reaches a point, usually on a nicer, cleaner head and shoulders, it would be like a perfect one. It would be like the right shoulder would be equivalent to the left shoulder in terms of height. This one isn't. This one went up a little bit higher, but it still fills out the pattern in my books. And then the head is always higher than the shoulders, obviously. People will like draw out some really, really ugly head and shoulders that are not head and shoulders. Like they'll draw out like we'll do the neckline like right here. They'll draw out something like this. Like the head's like barely above. And I'm just like, no, that's not a head and shoulders. I wouldn't think so, because if you look at it from different time spans, I mean, to me that looks like a 3-point drive, which I'll discuss in a little bit. But if the head is not clearly above the shoulders, it is not a head and shoulders, people. Like right there, that is a head and shoulders, a perfect head and shoulders. The neckline, the top of the shoulders are equivalent to one another, or for the most part. And then there's the head that sticks out, that's higher than the shoulders. That is the perfect head and shoulders. If you do it reversed, upside down, it's a bullish reversal. Here you go. Boom. This right here. I can't believe I already skipped this or missed this one. Actually, there's a little one right here I can see right here. Boom, down, up, down. That's a tiny little head and shoulders. But right here, if I use this tool again, left shoulder, head goes all the way down here, right shoulder. It's ugly, but it works. That head is way over the shoulders. That's how it's supposed to be. Not to that extent, but you get what I'm trying to say. It should be something like that, but whatever. This is a head and shoulders reversal. As soon as people saw this thing happening right here, boom, spike up. And then this is what I'm going to talk about later, the symmetrical triangle. All right. So those are the head and shoulders I covered already. The double top, double bottom, head and shoulders. The triple top. Bitcoin is horrible for triple tops and triple bottoms. I mean, the triple top and the triple bottom. I think it should be fairly safe to say that you guys can get the gist of that. Triple top is it touches the same point or area 3 times. I mean, even this could probably be considered a triple top right here. 1, 2, 3. Like I said, this little middle thing should not be counted on because that's just crazy volatility. I don't know what happened there. I can't remember. I was trading through all of this. I just don't remember what happened here. Anyways, 1, 2, 3. This could be considered a triple top right here. Triple top, crash, bounce, dead cat bounce, crash. This is a little head and shoulders right here. Another one. I mean, these patterns are everywhere. If you trade based off of these patterns, you will make gains. Definitely learn how to trade them. Head and shoulders right there. You see, so it came back down and then it started coming back up, but this is a reversal pattern to come back down. This is a bearish reversal. An inverse head and shoulders, bullish reversal. Regular head and shoulders is a bearish reversal. So then it comes up, creates a bearish head and shoulders, and then it comes back down due to the right shoulder filling out. Let's see. All right, so that's that. Let's talk about rising wedge and falling wedge. I think the perfect one for that is game. So I actually drew this out a little while ago, but I deleted it for this thing to make it look pretty. All right, so this right here, it doesn't look pretty on the 1 day. Gotta do it on the 4 hour. Bear with me. Let's delete that. I'll leave that there. Alright, so this right here is considered a falling wedge. Wait a second, what happened to it? I had this drawn way before. I don't know why I deleted it. Those are the bottoms. Was that? No, it wasn't that. It should have matched right there. I think it's in the 1 day then, because that spike is irregular. I guess I was right the first time. Yeah, I was right the first time. It was in the 1 day. So you see this pattern on the 1 day, you don't see it on the 4 day. That's why you have to check all the different time spans, and you got to chart them all. Because on some, you see this irregular wick right here. That's the one that was kind of throwing me off guard. So this is a falling wedge. Basically, it should be where there's 3 points that connect on the ceiling and the resistance. So this has 1 connection, 2 connection. You know, the candle wicks touch this, 2, 3 actually. 1, 2, 3. You can count that candle wick if you like. And this is 1, 2, 3, 4. I mean, this basically the price just almost rode the resistance all the way down. So as you can see right here, whenever there's a falling wedge, it's like a consolidation period, where this is a bullish falling wedge, a reversal falling wedge they call it. So it's bearish, it crashes, the price is going down, and then it like crashes down into this little tiny falling wedge where the price starts bouncing up and down until the point where it compresses. And it just so happened that the Bollinger Band, which I'll discuss later, it started bouncing on the Bollinger Band, and then when it broke out, it still had plenty of space within the Bollinger Band to go up. So it was on the falling wedge right here, created the falling wedge, and then it broke down because there was nowhere to go down due to the Bollinger Band, came back up, broke out of the falling wedge, came up, and then this is the crazy FOMO rally that we had today that, I said it went up like 20% in 10 minutes. So that's the falling wedge. Whenever you see a falling wedge, the price is going to go up towards the end of it. It's never, for the most part, I've never seen a falling wedge go all the way down into like the tipping point. It always breaks out somewhere over here. So don't even draw it like this where you see both ends touch. You want to leave it open-ended so you can kind of get a gist of where it's going to bounce up. If you draw it where they touch and you're aiming for the bottom right here, like you get greedy and you're like, oh, I want to get the very, very bottom. I'm going to put an order down here. It's most likely not going to fill. You want to fill it up way ahead of the 2 points touching. So like right here would have been like the perfect buy-in. Or right here too would be a good buy-in. But anyways, that's the falling wedge. In terms of a rising wedge, let's go back to Bitcoin. BTC USD. Recently we had a really big rising wedge up here. Let me show you. Let me just clear all of this stuff out. All right. It went all the way from down here. It was like down here to, yeah, right here. It was on the candle though. There we go. So scratch all of this stuff. I wonder if I can like just black it out. Okay, let's do this. Boom. Forget about all of that. Ah, you can still see it. Fail. All right, whatever. You just try to ignore that. So right here, you can see the top of the previous rallies. There's 1, 2, 3, which already makes it a strong resistance. 4, 5, and then there we go. Just hold on to it. And then 6. The 6 point. That was the tipping point where it sold at like 5,000. That's when I told people I was trying to get a short squeeze to make it launch up to 5,500 because then it would have canceled out that rising wedge and blah, 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 blah. However, it wasn't, it didn't happen. So from all the way back there to the support, which is all the way from when this whole thing started, all the way up, you can see 1, 2, it touched it, 3, it just bounces up here, and you can see that it's starting to go up. This wedge actually went all the way to the very tip, which is uncommon. It usually doesn't happen like that, but this is Bitcoin, and Bitcoin's extremely bullish. So people just kept on buying and buying and buying. And also, it didn't really confirm the rising wedge until this right here sort of hit. I mean, this could kind of confirm it, but it really, really confirmed when this bounced right here. So when it went up and hit the top, this top resistance would be the place that you would want to sell in a rising wedge because you know that it's going to have this big correction down. So this top resistance hits, you sell at either point, either this point or this point. If you sold out here and you never bought back in, you missed the train to buy back into the top, then it doesn't matter because you knew that a rising wedge was happening and the price would have crashed and corrected down. I mean, you can call it a self-fulfilling prophecy with the whole China news and this and that, but for some reason, this stuff works like that. They are all self-fulfilling prophecies. It makes you think that like Illuminati is like watching these charts or something. I don't know. For some reason, it always happens. Nobody expected this to crash down like that, but China came out with their exchange bans, and it matched perfectly with the rising wedge. Anyways, rising wedge is a reversal pattern, just like the falling wedge. This one was a steep rising wedge. It went up, and the bulls were not ready to buy back in until it corrected down for a while. You can see that like the volume at the bottom right here is like normal, 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 normal. And then as people sell out and don't get back in, they wait for the perfect time for the retracement. So when it's sold right here, you can see that the sell volume wasn't even that much. Look at the volume right there. Look at the volume right there. All this red volume isn't even that much. Even during the big crash Vader stick right here that happened, it still wasn't that much compared to this candle, which is smaller, which has way more buy volume. That's because everyone that shorted, that sold on the way up, we're just waiting for this major retracement, and it always happens. It happens time and time and time again. Every single time, it always happens. Major spike up, big retracement down. Major spike up, big retracement down. You know, what goes up must go down. I know we're in a bull market, in a perma bear or a perma bull market, but what goes up must come down. Some people are just waiting to buy back in. They bought back in. That's why I think that we're bullish over here, because unless these people sell out all right here, I don't think we're going to be touching 3K again. But what do I know, right? So that's the rising wedge and the falling wedge. Head and shoulders, triple top, triple bottom. We covered it all. Let's continue with the continuation patterns. Let me see if I can find one around here. See if a one day has a bull flag or a bear flag. I mean, this can kind of be considered a bull flag almost, except that crash. No, you gotta zoom in closer. Actually, game is currently going through a little flag right now. So this is considered, for the most part, I mean, this is an ugly flag, but it's just a nice retracement. Let me find a better example for you guys. OMG, maybe. Oops. We don't talk about Poloniacs in here. That's Voldemort. Let's see. I mean, this is a nice little bull pennant right here. As you can see, that I drew out, even though it broke. Didn't go through and didn't confirm. I mean, I see these things all day, every day, but of course, when I'm here doing this, there you go, perfect little bull flag. When I'm here doing a lecture, it's a lot harder to spot these. All right, so there's a bull flag. There's a long flagpole right here, and then you have this little period of consolidation, right? So basically, it's just one long flagpole, and then like a consolidation period of the price bouncing up and down. Usually, it makes some sort of a rectangular pattern on the consolidation phase, and once it consolidates enough for the RSI, as you can see during the flag, because during the pull, of course, it spikes up in the RSI, which makes it overbought. And look at how long. I mean, for hours it was overbought. It was crazy. And that's not even that high. That's actually like, it was overbought in this period right here. And then over here, it still continued going up, even though the RSI was going down, that's also pretty crazy. You don't see that often. That's why these indicators, you have to use more than one indicator. You'll get mixed signals a lot of the time. And if you trade just based off of like RSI, you will get burnt a lot more often than you think. So anyways, so the flagpole's made, and then this RSI right here, which you can see, I guess the flag starts like right here. It comes down, and because it was overbought for such a long time, it comes down and it basically stays on the floor for an extended period of time, all the way right here until, you know, it chills on the floor for a little bit, where it's basically oversold for a long time, and then it breaks out. And then it breaks out, and the RSI spikes up with it, and then things go back to normal. RSI goes up, price goes up, RSI goes down, price goes down, etc., etc. So during this is where I say it's good to ride the waves. You know, you see a spike up, a crazy spike up, and then as the spike goes up, and as you see the candles start to die down. Like right here, you'll see like the candle wick right here, a fairly large candle, and then another candle, and then this is a hammer. I'll go over how to read the candles more in depth in a more advanced lecture, but this is a hammer right here. You see that tiny little green candle, and then the wicks from in between. That's a reversal candlestick. So it starts to slow down. You can see that it starts to kind of curve and hit a ceiling. And then once you see that candle thing close, that's your cue to sell. So then right here, a big candle drop as people were trying to sell out. Oh, short squeeze. People were trying to sell out, and then when you sell right there, you want to sell out there, and then usually I go for halfway on the candle or on the pole, even though I guess this pole halfway would be like right here, because this is like one pole right here and then another pole basically if you look at the sell candles right here. So on this pole, halfway down the pole, it would have triggered right here. Your order would have triggered. If you put it up a little bit higher, then it would have triggered, 2 or 3 times. So if you sell right here, that's how I ride the waves. People think that I ride the waves like, I look at the 15-minute, and you can do this in the 15-minute as well. Though, like I said, I don't recommend it unless you're pretty experienced. But right here's a little failed pennant, and you see these patterns all the time. Pole. This is actually looks like a little ascending triangle almost, and then it broke down. Like I said, the ascending triangles are bilateral patterns. They do break down from time to time. But you don't want to be riding the waves like in the 15-minute where you're like buying here or selling here, buying here, selling here, buying here, selling here, buying. You don't want to catch these tiny little waves. It's not worth your time. It's not worth the headache. You want to wait. You want to look back at the 1 hour, or even longer than that, and sell the big pushes, the big rallies up, like a straight spike right here. You want to sell that. Big rally up here. You want to sell that at the top, and then you can buy back in at the bottom once the RSI levels out and everything, or once it triggers your order a little bit lower. So if you would have done that at the midway, sold near the top, bought near the top, or sold near the top, bought near the bottom, that would have been a 19% gain, which is awesome. That's a really, really good swing, actually. I usually aim for something a lot lower than that, like 10% or something like that, because 10% in the long run goes for, that's a pretty good gain on its own, a 10% short. So that's the bull flag. Let's see if we can find a bear flag. Bitcoin is definitely has tons of bear flags. Oh yes, and I can check out this short squeeze. I hate you, whale calls. You suck. Well, not whale calls, whale pool, I should say. That's right. I called you out. Anyways, let's look at a bear right here. There's a bear flag. You gotta zoom in though. So you see market's going bearish, drops down right here, and it creates this little rectangular flag where the price consolidates, tries to make a bounce up, and it just doesn't. The volume dies down and it just crashes back down. So it's a bear flag. It's a continuation. When it comes down, so let's say you're brave enough to try to set orders and buy and make bounces, or you just want to trade these tiny little bounces, right? You see some sort of support going on here, which is probably what happened. I don't know why people bought right there. Yeah, you can see like there's like a little ceiling support right here from this thing over here, or maybe it's a Fibonacci level. I think it was that little point though. I could see that people were I can see that people were definitely buying from here. That's what triggered the whole thing, this double bottom bounce right here. Anyways, let's see if there was anything else. Just a moving average from the top over here, and this moving average. Yeah, so it looks like this little bounce attempt was due to the moving averages from the past. That's why people put That's why people placed orders here. So if you're brave enough to sit in the vanguard and place orders on the way down, what's also known as catching falling knives, and you see like a little bounce attempt happening from where you placed your orders, and you just see that it's not really bouncing up strong, because usually a real bounce you'll see something like look, inverse head and shoulders, bam, 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 bam. You'll see like either a pattern start being made, or you'll see some really strong volatility in terms of the bounce. Like there's another inverse head and shoulders. Like you'll see something like, it drops down here and then it's like a spike back up. If you don't see that, then that's a pretty bad sign. You kind of got to track to see if a flag is being made. So if it comes down, you buy in, and it starts coming up a little bit, but then it starts, the bears are starting to sell again, and it comes up a little bit. Then whenever it comes up a little bit, that's your cue to get the hell out of there, because when a flag is being made, a bear flag is being made, it just means that it's going to come back down, and it's usually going to come back down even harder. So this kind of trickled down, a bear flag was made, people spotted the bear flag, and they knew, okay, this is my time, I need to get the hell out of the markets. So then they get out, and this huge, massive panic selling dump happens. And then, it tries to bounce here, fails, and then it does a real bounce. So that's the bear flag and the bull flag. For the other continuation patterns, we got the pennant. We have, boom, perfect, right here. There's a bullish pennant. Let's go into the 15 minutes so you can see it clearer. It's an ugly pennant now in the 15 minute. Let's do 1 hour. Actually, the 1 hour, this is a bull flag right here. Another little example. You have your pole, you have the flag, this little consolidation period, and then boom, another pole. Perfect example of a bull flag. I wish I had these things like all prepared beforehand. I just thought I'd wing it. Maybe tomorrow I'll hunt these down prior to, because I'm sure you guys don't like seeing me just skim through all of this. Is this pennant right here? And then when I do that, it just completely messes with me. I lose track of where I'm at. So yeah, for tomorrow and for the future lessons, I'll definitely have these things geared up for you guys, because I don't want to be here for 2 hours like this. Where is the pennant? Maybe that'll help. Bitcoin sucks with these. I don't trade pens that much, to be honest with you. Alright, I'll just cover pennant next time. What I did want to cover with you guys too, though, that I completely forgot to add on the PowerPoint, is the triangle. So, you always see people making triangles. This is a triangle right here. It's just the resistance comes down, the ceiling goes up. So let's delete this, and you can see the triangle right here. So the triangle, the support and the resistance, when it crosses, is either going to go up or it's going to go down. Since this is, crypto, like I said, it's pretty permeable, so you'll see a lot of the triangles break out bullish going upwards. But it's supposed to be bilateral. I didn't write that down in the presentation, but it just came to my mind. That's basically whenever someone says like, oh, you look at the triangle at X, Y, and Z. Usually you're just supposed to draw out the support and the resistance to see that it's going to come out to a breakout point. And a breakout point is basically where it's going to either break the support or it's going to break the ceiling, or I'm sorry, the resistance. Whenever it breaks either of them, because both have been respected for so long, whenever it breaks either of them, it's going to either drop dramatically or it's going to spike up. Usually spike up. That because that's an indicator. People that are very cautious traders, usually I would say the smarter traders, they won't bet their money into something ahead of time. They would draw out the triangle, and then you're going to see, I mean, I'm sure there's people right now waiting for Bitcoin to break the triangle. It's either going to break down or break up. So if they're sitting on the sidelines with fiat and they see that the resistance is being challenged and they're at the end of a triangle breakout zone, then as soon as it breaks this downtrend, you're gonna see a spike up. Trust me, it always happens. As soon as it breaks the resistance, you're gonna see a rather large spike down, but it'll probably bounce like, I think probably like right here, since there's this moving average floor right here. Oh, is this happening? Is this happening right now? Oh my God, look at that. Dun dun dun. Alright, so we may have a nice little short squeeze. A little bit too early to celebrate, but if that breaks it, it's awesome. Alright then, let's see. As far as the pennant, you guys can go look at the picture. Okay, I'm not gonna spend too much time looking for that. 3-point drive. A live example of a 3-point drive. I feel like we had that recently. Where was it? I know we had it recently. I think if I zoom in. There's a 3-point drive right here. I knew it. Where'd he go? Okay. So a 3-point drive is basically like when something tries to challenge something. It could also be a triple bottom. It could be a triple top. As far as oh wait, that's oh yeah, the continuation pattern. The 3-point drive isn't necessarily a continuation pattern unless it starts as a continuation pattern. So right here, this is actually a reversal 3-point drive. You can see the ceiling. You can start like from right here. Whoa, I have no idea what that was. It scared me. That's the ceiling. This is the floor. What was that? Scared the hell out of me. Anyways, this is the pattern right here. Starts right here. 1. Let me zoom back out. It was prettier with the 15-minute. Shut up, Neo. Nobody cares. Alright. So you got 1 point. It challenges this ceiling right here. Or it challenges the bottom 3 times. It bounces off the bottom 3 times. So 1, 2, 3. Wait a second. That doesn't sound right. Let me restart that. Right here. 1. No, it's not a 3-point drive. Where was it? This wasn't it. Well, anyways, if it challenges, if there's a ceiling and a top, I know there was one around here somewhere. It might have been on another exchange. That's probably why I don't see it clearly right here. It was probably on like Bitstamp or something. But when it bounces on the support 3 times, so 1, or it challenges the top 3 times, 2, 3. And then it's supposed to break down or reverse, so I did it right the first time. 1, 2, and then it happens right there or something. I can't draw it to save my life right now. Don't know why. It usually fills out, but whatever. I'm not spending time with this. I'm starting to hate this lecture. Anyways, so 3-point drive is basically, I'll just draw it out, right? There's a ceiling, there's a support, and it bounces 3 times in between. There you go. Bounce 3 times in between, and then it breaks out from that way. So as far as a continuation, if it came in from this way, right, and then it hit there, it'd come in, bounce 1, 2, 3, and then break out. That's a continuation version. If it was a reversal, then it would basically do this, which would be a triple bottom almost. So then 1, 2, 3, right? That's if it was a reversal or a continuation. Usually I see them as a continuation more as a reversal, because if it was a reversal, it'd just be a triple bottom. Anyways, tomatoes. And I believe the next things was the ascending triangle, which I already discussed with you guys before. In crypto, it's usually, this was an ascending triangle for Bitcoin. If you zoom out to the 1 hour, and I draw this little support right here. Was it this one? No. It was, this might break down still, but this is a little ascending triangle right here. But like I said, this is crypto, so it's always bullish. It should break as it bounces in between here, right? 1, 2, 3, and it comes down. It'll probably come down from there. I don't know if that'll confirm, but it comes down and then it breaks back up. It's supposed to be either break up completely or break down, but since this is crypto, it's usually always breaks up. So it'll break the ceiling and then it'll just continue going up. Oh yeah, that's right, I drew a bunch of them for you guys. Ascending triangle, ascending triangle, ascending triangle, ascending triangle. And the exact same thing for a descending triangle. It's the exact same, just the opposite. It'll go down. There'll be a floor. It'll consolidate a little bit and then it'll drop down. I'm sure I could find one in here, but I think you guys get the gist of it. It's like a flat line floor, or here. What was that perfect? One that I was just looking at. Let's just for J-hook. Let's do Neo. Oh, not Neo. Sorry. Whoa, look at that. Not Neo. Let's do, what was it? Monaco. There you go. Just for J-hook. I hope you're watching J-hook. So, for this, you can see right here, there's this little moving average floor that's built right here. And then a nice little descending triangle right there. And if I zoom in, make it look better, you can clearly see the moving average floor, the descending triangle ceiling that just kept, every time it bounced up, it just kept getting shorter right there, especially towards the end once I had 2 points confirmed. Every single time it came up right here, right here, right here, it just kept getting shorted on those two, on the ceiling due to these 2 points being confirmed. Now this broke down bearish and then came back up only because the markets crashed. This is when Bitcoin markets like really took a dump. So this shouldn't be really taken into play right now, because as you can see, it did come back up and it's now becoming bullish. So if Bitcoin didn't crash, if the markets didn't crash, I truly believe that this would have broke upwards. Just like the descending triangle or the ascending triangle, since this is crypto, these bilateral movements are usually bullish. So you'll see a lot of descending triangles that I think are most commonly actually supposed to be bearish. You'll see a lot of these breakout bullish as people start to collect at the bottom floor along the way, and then the sellers kind of leave the market, and then the buyers just start pumping the market up, and then the bulls get back into play. So you can see right here, though, the sellers sold the market, and people just started buying it all up, and now it's going up. Congratulations, J-hook. So that's the descending triangle, and then the hardest, and also I would say one of the more rare bilateral patterns is the symmetrical triangle. This is something that gets a lot of people mixed up and confused. Where was it at? I think it was in the previous rally. Yeah. There's something that confuses a lot of people because they don't know what the difference between a pennant and a symmetrical triangle is. I always find the symmetrical triangles to be, first off, the first indicator. This is a symmetrical triangle right here. I'm just going to draw out the supports for you. So it starts like right here. You can see where it respects all of those. And then right here. If I did the 4 hour, I think it'd look prettier. Way to go, TradingView. I hate this right now. Come on. There we go. 30-minute, awesome. Alright, I'm just gonna stick to the 1 hour. But trust me, this was a symmetrical triangle. I covered it. I traced it for on live on Twitter. Anyways, so I think it's because we're in the 1 hour, but these tops should be short down on the other time spans. But this was a symmetrical triangle where it came up, hit this, bounced down, hit here, bounced up, hit here, and then it 3 points touched at the top, 3 points touched, or more than 3 points, 1, 2, 3, 4, 4 points touched at the bottom. But basically, I mean, the symmetry is there in terms of it being completely, for the most part, equal. Like you don't see like so much of this like being like upwards like that, something like that. You see it for the most part. They're both equal in terms of. Oh, there you go. You can kind of see it a lot clearer like that. They're both equal in terms of the angle of the support and the resistance. And then as well for the symmetrical triangle, I always find that it's like the entry into it is just this massive pull that's being made. Like people thought that this was a bullish flag, Deemeister or whatever his name is. Like a bunch of people were like, they were just placing bets. This is one of the things that got me big on Twitter, is because everyone was bullish on this because, oh, it's a bull flag, it's a bull pennant. Like, oh, we're gonna rock it to the moon, and I'm just like, no, we're not. The market's split. We don't know what's gonna happen. But nobody listened to me. And then, but I was able to tell this was a symmetrical triangle instead of a bullish pennant because of the entry. Like I said, there's always a large spike up, whereas in a bullish pennant, it'll usually be, instead of this massive like straight incline rise, it'll usually be something like that, like a more natural, organic, incline. Like even if it's like super bullish and it came up, like it'll usually be something like this, like something more natural and organic. This is not natural and organic at all. This is, it hit a bottom. Freaking, what do you call them? Jihan started mining the BIP 91 soft fork thing, and as soon as that happened, everyone was waiting for it. As soon as that happened, they just longed the hell out of the market. So this is just a bunch of long orders, just squeezing out the shorts and just skyrocketing up. And it grew way too fast. So as soon as I saw that, I was like, wait a second, there's not, there's a, you can't sustain that price. Not this quickly, at least. Even if the market did crash, like you need to give people some time to enter back in the market. They don't want to enter in when it's when it's skyrocketed. They want to enter in at a better price. The people that did sell and the people that got their short squeeze right here, because people that got their short squeeze right here, they most likely didn't buy right back in. They were gonna wait for the retracement. So when this retracement happened and it bounced up and hit right here, and then it just happened again and it continued, I could tell that this was a symmetrical triangle, and I didn't even say that it was gonna drop. I thought that it could have very well, like that's the perfect symmetrical triangle. Like I said, if you look at it in the 4 hour, you don't see these parts sticking out. But I didn't know if it was gonna drop or spike up. All I did and all I tweeted was to practice risk management, and I just told people, I'm gonna get out, and I would rather get back in, because I did exit out like somewhere like over here or something like that. I'm gonna get out and I'm gonna get back in when I'm for sure that we're in a bullish in a bullish market. So if I would have just stayed in here and it would have broke down, I would have lost. Like I would have been holding bags for a while. Oh, like this is a 3-point drive. 1, 2, 3, boom. Anyways, if I would have just if I would have held, I could have risked holding bags for a while, or I could have made some pretty sweet gains, or I could just sell right here and then wait for the breakout, because I was tracking this live. I waited I was up to like 3 a.m. or something like that. I waited all the way to the very tip. As you can see, it waited. It took out as much space as possible because the market was completely split. And I tracked it live. I was looking at the 1 minute charts. If you look at the 1 minute, oh, God, I hate this. All right, we're not going to look at the 1 minute. If you look at the 1 minute, though, for this symmetrical triangle, this big bar right here, it came down like one order, like up to right there. It was just this huge dump from Spoofy or some huge whale. I don't know who did it, but they had some real big money. And that's when I tweeted out, oh, it's gonna come down, the sky is falling, blah blah blah. Because as soon as that happened, it triggered stops, and then that's where you see this big panic thing occur. It triggered stops all the way down, and then people started panic selling, and it dropped down further, and blah blah. And then the person that dumped over here was most likely the whale that I caught accumulating down here, and then it launched back up once I saw the whale accumulation and tweeted about it. And etc. etc. But that's a symmetrical triangle. Usually you don't see them in alt markets because you can't margin in the alt markets, or unless you're like on Poloniex. But this is usually made, in my experience, to margins. So like a bunch of longs were here, and then the market got split because there wasn't that many buy orders. Like regular buy orders, and then at the same time all of these longs that were made up here, right here, got squeezed out down here. So you want the bulls, the perma bulls, end up becoming bears because they want to squeeze that out and short it down. So the market gets all confused and they don't know if they want to go up or down, and that's what makes the symmetrical triangle. And I wonder if I should cover the indicators tomorrow because it's getting late. Actually, I think I'll do that. I'll continue the rest tomorrow with the indicators. If there's anything else that you guys want me to cover tomorrow, was just the very basics of the trend lines and patterns. If there's anything else that you guys want me to cover tomorrow, ask me or write to me at the Discord. Right after this, I'm going to be answering questions for a little while, so if there's anything there, let me know. Don't forget to like and subscribe. Alrighty. Later, guys.